It's not quite your sex, drugs and rock and roll type fund. It's a fund that delivers consistent performance. So we needed something that stood our product apart from the rest of the market, and that's really resonated well. That's the most powerful thing for me, is just taking little bits and pieces from all the other investors out there, whether you read more, whether you listen more to your colleagues out there, and take away that good stuff about investing that they do and develop your own way of investing. And that can be very powerful.
You're about to hear a podcast with Michael Bell, the Chief Investment Officer of Solaris Investment Management. If you're interested in why the stock market seems so volatile lately, why CSL seems to crater and CBA seems to be at really high valuations, this is the episode for you. In this podcast, we talk at length about the team behind Solaris, which has been together for a very long time. In my opinion, it seems kind of unusual. How do you get so many good analysts to stick around for such a long period of time and produce really good results? We talk a bit about how an investment team can come together and formulate a process that then produces investment strategies that match. Not trying to create the investment strategies and then finding the team that matches, but the other way around, having the team that kind of produces the strategies that make sense for them. We talk about long-short investing. We talk about index investing and why active investing may actually have its time in the sun going forward. There's so much to cover in this episode with Michael Bell of Solaris Investment Management. Thanks for listening. Global X is a leader in commodity, thematic, and specialized ETFs. Global X has been a partner of Rask for many years, and I'm so excited to witness their rapid growth over that time. Their range of ETFs, in-depth research, and focus are all designed to help you invest better. Visit globalxetfs.com.au and tell them Rask sent you. I'm hearing a lot of investors asking the same question. Where can I find reliable income in this market without taking equity market risk? That's where Term Plus comes in. It's designed to maintain a steady buffer over the RBA cash rate, providing regular distributions and somewhat of a cushion and diversification on your passive income. To find out more about Term Plus, simply search for Term Plus or head to termplus.com.au, where you can find the PDS and TMD. And don't forget to tell them Rask sent you. This episode is brought to you by Stripe, helping your business be ready for whatever comes next. And the next shift in how people buy is already happening. Agentic commerce lets customers discover and purchase directly inside an AI conversation. No checkout page, no friction. 86% of the Forbes AI 50 build on Stripe. The businesses positioning themselves now are the ones who will lead this channel. Whatever comes next for your business, power it with Stripe. Learn more at stripe.com. Michael, thanks for taking some time to join me.
Pleasure to be here, Owen. Thank you.
It's good to have you in the very sunny Melbourne weather, which I'm sure you're appreciating.
Well, it's a bit of a shock to the system. It's a little bit colder here relative to Brisbane, but good to be here.
Yeah, it is indeed. So we're going to talk about your investment process, business, the way the market is shifting in terms of people's appetite for different investment styles and that type of thing. But maybe to kick things off, tell us a little bit about your first role in funds management. I heard a story of how you got started, but I think it would be quite an interesting one to see how that journey evolved.
Yeah, no, that's it has been a journey. And so for me, probably before we talk about where I started working-wise, it's probably worthwhile going back to when I was at school. And my parents gave me $500 worth of CSR shares at the time. And I opened up a brokerage account at the age of 15. And these days you have to wait until you're 18 to open brokerage accounts. But I was pretty active in buying and selling shares. They used to have a newspaper called the Daily Telegraph, which had an afternoon edition. And I used to buy that paper in the afternoon just to check out the share prices and how they traded for the first hour or two of trade. So I really developed a passion early for the markets. I went on to university, studied accounting, but really enjoyed the finance part of that. And then came out of uni at the time when we were going through the 93-94 recession. And that was a difficult time to get jobs. And at that time, I really knew I wanted to get into markets, didn't particularly know whether it was broking or funds management. But there was an opportunity at Suncorp Investment Management working in the operations area and doing work for the equities team. So I grabbed that job, and those sorts of jobs back then, you worked very hard, didn't have any responsibilities, so I could spend a lot of time focusing on the job and delivering to the equities team. I did get noticed by the equities team, and when a dealing job became available, I was the junior dealer at Suncorp Investment Management, and that was about 97. So I worked there for 10 years. We had a very good team. The strength in Suncorp back at the time was the team that we had there. We had good performance, and that got recognised. And that got recognised by Ian McCown at Pinnacle at the time. So worked at Suncorp till end of 2007. We had some pretty interesting markets, but they finished pretty strong in the end.
Yeah, it would have, from the late 90s through to 2007, which is the time that I'm aware that things did take that shift for you and Ian approached you. Can you talk to us a little bit about how that came to be? A lot of people that follow the show or our network are very familiar with the Pinnacle business and how it kind of operates, but I feel like there's a lot of relationship in there. There's a lot of softer things that come into play. It's not just, we've got Pinnacle has these affiliates, but like, how does it actually take place? What was that conversation? Why was it right for you to do that? Like, talk us through that.
Yeah, great question. So when we were at Suncorp Investment Management, that was a bank and insurance company at the time. They were very focused on banking and insurance, and that was a large part of their profitability, and that was fair enough. For us, we had a base salary, and if you were lucky in a given year, if the bank had done well enough, you might get a bonus. And so it was an interesting environment to work in. Given the outperformance that we delivered for Suncorp and their clients, we started to get recognised, and that was not long after Pinnacle started. At the time, Pinnacle was part of Wilson HTM, and they were looking for quality teams to join their business. And we got approached by Pinnacle through Ian McCown, and he is a good salesman. And part of his sales pitch was, look, you guys can do a lot better. You can get your base salary, you can get your bonuses if you do a good job. But importantly, you can have skin in the game via ownership in your business. And that was a pretty powerful message. And it wasn't only that, but it was also, his pitch was, well, we can structure this so all you do is invest. We will look after all the back office, the HR, the finance function, the distribution, so you can concentrate on investing. And so that was a very powerful message to give to, at the time, was a pretty young team at Suncorp Investment Management. So it resonated with all of us, and we lifted out as a team in 2008. So it was January 2008, and it was interesting because we had $5.5 billion under management at Suncorp, and we went to 20 million at Solaris, and you pretty quickly realised who your friends were in the markets, which of the investment banks would support you and which wouldn't. And fortunately, we got some pretty good support from the investment banks. I think had we known that the market was going to be down 55% at its worst that year at the start of the GFC, maybe we would have rethought that decision, but it was a fantastic decision in hindsight and a good decision for our group to make.
So 9 of you lifted out of Suncorp, and then you had that $20 million of seed capital to invest. Were you, I don't know exact timelines here, were you deploying that capital on the way down, or how did that kind of timing element work? Because like you said, in hindsight, it's probably a great time to be beginning a business like this. Talk us through that a little bit.
Yeah, so that 20 million of seed money was invested day one.
Right.
So it was invested day one. I mean, fortunately for Pinnacle, we did reduce the market exposure with that, with taking a put position in the SPY, which took out the market direction for Pinnacle, and it was our performance that was delivered to them. But we invested day one, and our business is all about outperforming the benchmark and the index, and we call the index the ASX 200. So our clients give us money and they say, we want you to outperform the index by 2 to 3% year in, year out. And so that's our job. And we got off to a good start at Solaris, and we got our first real client after the seed money on the second day. So that's really powerful. And we had some good support from asset consultants across the early part of the journey. And we did win some money pretty early on in that process. We broke even after about 18 months. So that was a really strong signal. These days, you probably need about $2 billion under management to break even in your business. And at the time, we probably had about $1 billion. So that was a real milestone for us is breaking even. We went into retail in about 2011, 2012, and then we've grown since then.
The team that you have, you look at the tenure across the business, and it's incredible actually how many people have been with Solaris for such a long time. That's not that common. And I think that's a really important point because people miss that when they look at a great track record, if the team's not the same, then the team that produced that track record, aren't necessarily there today. So what you're getting may not be, what you think. But in your case, you've managed to keep all these great people. Probably my broad question is, what keeps people in the seat? Why do they want to keep working at Solaris? So you mentioned skin in the game, those types of things. Like, how important are those incentives? There's so many questions I have.
Yeah, there's a lot to that. And look, we joke a little bit about this at times, but one of the reasons why people like working for Solaris is it's based in Brisbane. There are barriers to exit. There's actually not that many places you can work as opposed to Sydney and Melbourne. But the real answer is that at Solaris, we are a little bit different in the way that we empower our analysts, and we call our analysts sector PMs for their sectors. So at a traditional fund manager, you have a star PM that sits above the analysts and takes recommendations from those analysts, but ultimately that star PM decides the makeup of the portfolio. So they're effectively covering 200 plus companies. At Solaris, we break up the market into each of the analysts gets 30 to 40 companies each, and we empower the analyst to decide which companies go into the portfolio and the size of those positions. And it's subject to authorization by the CIO, but it's important that empowerment. So each of the analysts is actually the sector PM for their sectors. And there's a lot of people in the market who they're analysts, but they want to be that star PM. And at Solaris, each of the analysts can be a PM, and it can work. And we believe it works better because it's much easier to cover 30 to 40 companies than it is to cover 200 plus companies in the market. What that actually does, Owen, is it allows us to both attract and retain really good people. And you can attribute the performance that each of those analysts makes to them, what they deliver to their client portfolios, and they can get remunerated as such as well. So, it's very powerful, that empowerment, but you're also rewarding them based on what they deliver to the client portfolios. And then in addition to that, you've also got the equity ownership, and that really promotes a strong culture at Solaris. And in addition to all that, we do have a number of funds that have performance fees associated with it. So again, very good alignment with our clients, which is really important in funds management.
Yeah, I've got a lot of questions about this, the investment process, and also the fact that you give investors a choice between performance fee or management fee. Like, there are firms that do it, but a lot of times those aren't accessible to people. So I was looking at your most recent investment deck or slide presentation, and there's some really interesting pieces in here, particularly around like the analyst involvement, which you said. But you have, say, a universe of, say, 220, 250 plus somewhere. You can be precise if you like. And then I saw a thing that says you do 500 meetings a year. Can you describe the broad investment process? Like, from beginning to end, you're obviously on the ASX, so you've got many different securities. You've got your benchmark that you're trying to beat. But what makes up the universe? How do you distill that down? And then what happens from that point?
Yeah, so I might address that first question you had about the different classes of fees that we do have. So you're right, in our core strategy, we've got the standard 90 basis point fee that we do charge investors on one of our classes of funds. The other class is what we call the performance alignment product, which charges a zero management fee, or MER, and only charges for outperformance. And that is the fund that's got the most money in retail that we've got, and that resonates really well with clients. So we only get paid a management fee if we outperform the index, and we aim to outperform by 200 to 300 basis points of the benchmark each year. If we get that 300 basis points, then we earn 90 basis points. So that's in comparison to the 90 basis points we charge on the other product, which is pretty similar to what you see everyone else in the market charge. And that zero MER product is very unique in the market. And so we're really about the only people who provide that product. But it really provides good alignment between both ourselves and our clients.
For sure, yeah. That's the math's actually really interesting there. The 3% or 300 basis points is really interesting.
Yeah, it's interesting, Owen. We made this decision back in 2012, and we really needed to differentiate ourselves from the rest of the market. There was high-octane managers out there who took big style and sector risks and had sort of quite big numbers, quite volatile numbers. And then there was Solaris delivering 2 to 3% per annum. And it's not quite your sex, drugs, and rock and roll type fund, but it's a fund that delivers consistent performance. So we needed something that stood our product apart from the rest of the market, and that's really resonated well.
That's really good, and it's interesting to see people gravitate to that, because for folks that don't know, in the industry, there's this big tension between performance fees and management fees, and some asset consultants like performance fees, some don't. It's like you can't be everything to everyone, but if you just give the choice, it makes a lot of sense. How about in terms of the investment process then? So you've got the ASX as your universe. What happens from that point?
Yeah, so we are a fundamental manager doing both quantitative and qualitative research. So our universe essentially starts with the top 300 companies. But what we're doing at that point is we've got a filtering part of our process. And what we're trying to do is filter out what we view as uninvestable companies. So we don't want to do the work on those companies, but we view them as uninvestable. So that might be because of liquidity reasons. It could be for balance sheet reasons. So they've got an extremely poor balance sheet. It could be geopolitical reasons. So we don't really want to invest in a lithium explorer in the Congo, for example, because it carries way too much risk for our clients, that part of the market. It could be there could be an ESG factor. There could be a governance factor that makes our company uninvestable. So we're really ruling out 40 to 50 companies at that point, and we come down to around about 2 to 250 companies where the analysts do all the work. And at Solaris, there's 7 investment analysts, 2 ESG analysts, and we're doing that quantitative and qualitative research. Now, there are some qualitative factors that are important to us at Solaris, and some of the big ones are an assessment of management. So management is extremely important when you're investing in a company, an assessment of the balance sheet of a company, any ESG factors, the industry structure or the business model in which a company operates, again, important factors in certain industries, the cash flow profile of a company, and the trend in return on equity. So we're assessing all those factors, and each of the analysts has 30 to 40 companies they're doing that on. They are doing forecasts for capital return, dividends, and franking in the portfolio. So each of those companies has an expected total return, and what we're doing is we're then ranking those companies in expected total returns and investing in those companies that have got the positive returns, the higher returns, and really avoiding those companies with the negative returns. Now, as part of the analyst work that they do a lot of meetings with companies. So you referenced 500. There's actually 500 plus. So I think last year was probably 800 meetings.
Wow.
So there's a lot of meetings that take place, and it's not just with the listed companies. So we're also talking to unlisted companies. We're doing expert networks. We want to get our edge in the market that allows us to identify some of those inefficiencies that are evident in the market. So there's a lot of work that you can do, and we're on the road. Going to Brisbane, Sydney, Melbourne, Perth, traveling overseas to China, US, and Europe, really to get that edge.
It's interesting because I was reading some of the latest monthly reports, and at the back there's this table that has the yield, the franking, and I think it's just the expected return total. Do you also do that? You do that relative to the market as a whole, right? So you're basically, this is a great resource for anyone that's watching and listening at home. Like, the team at Solaris basically do all the hard work and then give you this really neat table at the end of the monthly update that shows like industrials, resources, different sectors and expected returns and respected growth based on that. So your team's effectively looking at what you deem to be the market and all of the kind of the slithers within that. Is that fair to say?
Yeah, so we cover the entire market and we're doing forecasts across all those companies. So we do have a well-resourced team at Solaris doing that work. And so for each of those 200 plus companies, we are doing those forecasts. And they're not just for the next year. You're doing 4+ years of forecasts. And I'll look after infrastructure stocks. And for toll roads, I'm doing forecasts out to the end of the concession life for these toll roads. But it really depends on the companies and the sectors in which an analyst is covering. Banks, for example, you might only be forecasting out 4 to 5 years, but there's a lot of work that goes into forecasting returns in the future. The next 6 to 12 months, we don't really focus too much on because we really believe the inefficiencies in the market that we see, and we're looking for inefficiencies in either earnings forecasts for the market. So that's, when I talk about the market, that's other investors out there, and we can see what people have got in terms of forecasts, particularly the investment banks for the various companies. We're looking for inefficiencies in earnings and valuations in the future, but it's those inefficiencies really show up past the next 12 months. We really think that the market is typically well known in the next 6 to 12 months, and those inefficiencies arise sort of 2, 3, 4 years out.
That reminds me, it's actually price earnings ratio. I think you do your own forecasts and a few other metrics which are really valuable, earnings per share. Because in Australia, there's just not that many. There's not that many places where you can go and you can actually see what the expected earnings of the whole market, whether it's market weighted, market cap weighted, or whatever are. And I found that really interesting. And I was looking at the data. I was really surprised at how your team had forecast how well some of these businesses are expected to grow in EPS terms. Like I thought, wow, it's actually pretty good. And I thought it was actually reassuring for me as an Australian investor. I was thinking, it's actually giving me hope that Aussie companies are growing, Aussie companies are doing good things. You mentioned before that effectively, like the analysts can have, one of the great things is you kind of push the authority down the team to say, you guys, quote unquote, who are analysts, you're actually responsible for the portfolio as well, which is quite unique because in many traditional firms, it's the portfolio manager makes the weighting decisions. I'm curious how many stocks you have in, say, any one of the portfolios, and how those weighting decisions are made. You mentioned like ranking. Is it a simple weighting? Like, how do you think about that?
Yeah, that's a good question. So they're weighted based on the expected returns that we have for each of those companies. So the higher expected returns are the companies you want in the portfolio. So the higher the expected return, the higher the active position size will be. So when I talk about active position size, it's relative to the benchmark. So if we've got a company with a 10% expected return, for example, it will have a 1% active position in it. 15%, 1.5%. So that's the rule of thumb. And similarly, companies that have negative expected returns are either underweight or we don't have them in the portfolio. Importantly, we have strong risk management at Solaris. So we have company and sector limits. So for our core strategy, it's plus or minus 3% away from the benchmark, and the sector limit is plus or minus 5%. So the analysts have these constraints to work within, but what that actually delivers is more consistent returns over time. But importantly, the majority of the risk and return that you see in our portfolios comes from companies rather than from big style or sector bets. So if I looked at the portfolio today, there'd be about 70% of the risk comes from stocks or companies, with the remaining risk coming from styles and sectors. And when I refer to styles, it's like a growth bias or a value bias or a cyclical bias or defensive bias. And so we view ourselves as pretty good at picking companies, not particularly good at picking the lithium price or the oil price or interest rates. And so we want to focus on where we can add value, and we can do that by picking good companies.
This podcast is proudly brought to you by Pearler, the official brokerage platform of Rask. With Pearler, you can effortlessly automate your money, whether you're investing in ETFs or shares from Australia or the US stock market, whether you're a grandparent or setting up a kid's account or your own account. You can do all of that with full automation on Pearler.com. If you want to learn more, head to Pearler.com/Rask And of course, before you invest in anything, be sure to read the legal documents like the PDS and FSG. Thanks for watching this Rask podcast. I want to tell you a story about how the new Rask platform came to be. In 2025, everyone was still waking up to this idea that AI was going to have an impact on the world. And it wasn't until mid to late 2025 that it really hit me like a ton of bricks. At that time, I thought, what can I do with this new tool, this innovative technology? That set in motion what has now become a totally new Rask platform, which you can find at rask.au. It is 100% free to create an account and start using tools. But what did it actually do, and what does it do for you? At Rask, we've produced thousands of podcasts, probably 20,000 articles we've written on investing and all of these different types of things like personal finance, superannuation, you name it. So we really needed a place where we could bring all of that together for the entire community. But once we built the platform, we realized that that wasn't enough. So in 2026, we've decided to launch a new community known as the Rask Ultra community. This is the deepest, most advanced part of what we do as a business and as a community of investors and builders. We want to build a network of people that can come together and share ideas in a new ecosystem that we've built just for you. You can find out more, like I said, by Googling Rask Ultra or by creating a free account at rask.au and see if Ultra is right for you. It's actually really interesting. That's kind of the second element of the constraints is avoiding that. And one thing, I think this is a subtle thing that a lot of people miss for what it's worth, is this idea that if you do have a concentrated portfolio, sometimes that may result in better outcomes. But many times from a behavioral perspective, like your end investors that may be listening to this or watching it, they could make really impulsive decisions based on short-term performance if you had been really concentrated. So, and it's really interesting how you articulated like the alignment with the analysts or sector PMs. I had a couple of questions in here, but one of them was this idea of improving industry structure. I saw that a couple of times around the traps when I was doing some research on you and the team. It seems so obvious to me that you would invest where there is an improving industry structure. In your opinion, like why is that important and what do people get wrong about it?
Sure. So an improving industry structure can lead to improving pricing power for a company. And I might give you an example. Suncorp, which is a company we invested in, interestingly, we did work with Suncorp many moons ago, but we invested in Suncorp back in 2022. Mm-hmm. So the company had gone through quite a few years of catastrophes on the East Coast, a lot of flooding. We'd been through a period where La Nina had been in for 2 to 3 years, and it was having an impact. The investment community was taking a view that climate change was changing things forever for insurance companies, and you just had to get used to these types of storms and floods. And while we have sympathy for that view that climate change is impacting insurance companies, the current view at the time was that, or our view at the time was that we were going through a La Nina, and that was impacting conditions much more than climate change at the time. So what we saw in the case of Suncorp, we saw a company that had been sold right off. It was trading on a PE of 10 or 11 times. It was at cyclical low earnings. But what really hit home to us in terms of that industry structure was we do a lot of meetings, as you talked about before, Owen, and we see a lot of unlisted companies, and we visit a lot of the unlisted insurers, so the Budgets, the UEs of the world, really to get an idea of the competitive landscape. And prior to those catastrophes, you saw those companies competing really hard with the likes of IAG and Suncorp. And IAG and Suncorp were losing a lot of market share. So that was a industry structure that was deteriorating. When we saw those catastrophes happen, what you saw was a lot of those brands like the Budgets and the UEs really pulled back their competitive tension because a lot of capital had been lost throughout those catastrophes. So we saw a change in industry structure there. So that is really powerful for us when we see that sort of event happening. And you need to get on the ground and do the work to find those opportunities. So we did see that industry structure changing. We saw the market share losses start stabilising for Suncorp, and we could actually see that this is a great opportunity, because what we did know in the future was that it was likely that these catastrophes, as we move from La Nina to El Nino, would likely start to dissipate, and you would get better conditions. And so it would allow Suncorp to start raising prices, and we've all seen that, Owen, over the last few years. We've seen a lot of price escalation in insurance policies, both in home and contents, and also in motor. So that was a great opportunity. We've had pretty good conditions over the last few years since that period, and what you've seen is Suncorp's profit actually materially increase, but at the same time you've seen that company re-rate. So that PE's gone from 11 times to 16 times. So that's been a very good investment, and that was really that change in industry structure and that pricing power.
That's a really, really good example. And like you said, close to home, which is great. The thing that I also noticed is it's not just like a long-only portfolio that you run. You've also got a short side where effectively, for folks that are unfamiliar, you can benefit from falling share prices. One AFR article that I saw, actually, it said effectively that there were 3 different reasons that you would consider short selling, or 3 different like kind of strategies. There's ones where, you expect the stocks are going to fall. And so you're just a pure alpha bet, I'm guessing. Another one where you might have the stocks just likely to underperform in your view, or a pairs trade. I'd like you to maybe just step us through how and why you use short selling in the way you do.
Yeah, good question. So at Solaris, we have 3 strategies. The Solaris core strategy, which is long only. We've got the Solaris income strategy, which is long only as well. But we've got the Solaris long short, which is a 130-30 strategy. So going 130% long in the portfolio and 30% short. Effectively, you're 100% long in the portfolio or invested in the market. So shorting is very powerful. And we, in our jobs, we see a lot of great opportunities to invest on the long side. We also see a lot of companies that we don't want to invest in that we believe will underperform. And so having the ability to make money from shorting is fantastic. And so we've had a product there that's been able to win from both investing on the long side, but also being able to invest or to go short on the short side. Now, shorting doesn't have to be scary, and it doesn't have to be risky. And the way we think about investing on the short side at Solaris is we want to have around about 30 shorts in the portfolio. So we want a diversified short book. Now, we don't want to have, it's pretty hard to have the whole portfolio full of corporate travels in the portfolio. That's a company that's down 80% probably, or 100% potentially from where it last traded. It's pretty hard to come up with 30 of those in a given year. So what we try and do is we break up the market into outright shorts, and corporate travel is an example of one of those that we shorted in the portfolio, and we've had the advantage of that company doing poorly. We've got those outright ones, and that's where we expect there could be an event, or we expect the share price to go down quite materially. And so we've got a proportion of our shorts are in outrights. It's probably about a third. Mm-hmm. And then we have another third comes from funding shorts. And funding shorts are companies that you don't expect to outperform, and we don't mind if they perform in line with the market. But what they're doing, along with the outright shorts, is they're liberating capital or money from when you short to then invest in those companies on the long side that you really like and increase the size of those positions. But those funding shorts are lower risk in nature. There may not be any catalyst in the future for them to sell off aggressively, but you just don't think that they're going to outperform. And a good example over the last 5 years for us is AGL. So it's within my sector, utilities. That's a company that we believed was going to go through a transition. The coal-fired power stations were going to retire over the time. They would have to replace those earnings with renewables, and we viewed that as very costly. But that's something that would take many, many years to play out. We shorted it at $20 probably 5 or 6 years ago, and today it's trading at around about $9. So that's been a fantastic funding short, low risk, really to complement those outright shorts. And then the third bucket, the other third, is what we call pairs. And so So a good example might be a gold company, and you don't like the management for the gold company, you expect their operations to underperform, and you want to short that gold company. But it might have way too much macro risk. And the last 2 years have been a good example. The gold price has been on a tear for the last 2 years. So if you've been short a gold company, even if it had underperformed operationally and its management was terrible, a rising tide can lift all boats. And so you can get really burnt in a short like that if you don't cover that commodity exposure. So in that case, we pair it up. We go short that company we don't like, but we go much longer in a gold company that we do like to take that commodity risk out. So those three buckets of shorts deliver a diversified book of shorts, and we view as lower risk than trying to come up with 30 outright shorts of corporate travel or such.
Yeah, that makes sense. And for folks that are playing along with Michael's point, the middle bucket there is very important, because that's the one where you can short sell, take the capital, and then put it into your better ideas. And then you can get that 130 rather than the 100 that people are more familiar with. Is there, since you've been doing this, have you had more or less success in one part of that short selling book?
Not really. It fluctuates over time. Sometimes you're more successful in certain parts and others not so much. So pairs have been a little bit of a struggle over the last probably 12 months, particularly in resources, because what we've seen is all resource companies go on a tear, and particularly some of those lower quality companies that will tend to short because of the way that commodity prices have been going. Some of those companies with poor management, they might operate very high on the cost curve. They've got the greatest leverage in this market. So pairs have probably hurt a little bit, but funding and outright have been very good in the last 12 months. But in other times, pairs have been fantastic for us. So it really depends on the environment you're in.
There's this other element, which is probably like if short selling's on one side, and then you've got, long only and long-term fundamental investing on the other side, where you see conditions improving, there's probably this place in the middle, which is where some of the things that you guys are known for is like this contrarian idea, this idea of contrarian investing, out of favor companies or what have you. Can you maybe just give us an example of why that's why contrarianism is in the way that you invest? Like, how does it fall out of the process of what you follow? And because I've seen a few write-ups of like journos covering you guys and some of the positions you've had over the years, but maybe just talk to us a bit, like, what is contrarian investing in your opinion, and how does it work into how you invest?
Yeah, interesting question. And look, we're from Brisbane, and quite often we get clients saying that our portfolio is quite different to a lot of the other portfolios that they see from managers in Sydney and Melbourne. And maybe that's because we don't go to all the same meetings. Maybe we don't hang out together at lunchtime. But it really allows us to think for ourselves and have our own opinions on companies. Typically, if you're not contrarian and taking a different view to market, it's also hard to outperform. So it's important that you are contrarian in this market and take different views, but you don't necessarily want to take extreme views in our market.
So one of the strategies that you mentioned before does have an income focus, and you can forecast franking credits and all those types of wonderful things, which we all love here in Australia. Can you talk to us about how you see the kind of risk return, or just the opportunity set of income versus capital growth? Maybe this is through the lens, Michael, of why would people choose that strategy over, say, the core strategy?
Yeah, so it really depends on the type of investor that is going for that particular product. So our core strategy has much more growth in it than our income strategy. They invest in the similar sort of companies and same process that we go by, but we really chase income in our income strategy. And so if I look at since inception, so our income strategy has been going for almost 10 years now, the total return return in the income strategy has been just over 10%, and the income component of that after fees, including franking, has been about 8%. And so with the core strategy, you're getting a similar total return outcome, but the makeup between both the capital and income is different. So why, as an investor, you'd gravitate towards our income strategy? It might be that you need or want more income in retirement. You might want more consistent income during retirement. So we have products that have the same process, but they'll chase different things. And so that income strategy can get that higher income because it does focus on generating income. And how we do that? Well, we're not just investing in the highest income payers in the market. It really comes back to our process of investing in those companies that have got those positive expected returns. So what we'll do, we will chase more ordinary dividend income. So we'll increase ahead of ex-dividend dates. We will increase the positions in that portfolio, take them much higher in companies that we like to get higher income. And once we get through that ex-dividend period, we then take it down to our target active position. So that's one component, Owen. The other component is that we look for special dividends or tactical opportunities. At Solaris, we focus on two things: the ability of a company to pay a higher dividend or a special dividend, and that's quite quantitative. And so that's looking at the company's forecast for cash flows and earnings in the future, looking at their balance sheet, and looking at their franking balances, and looking at that ability to pay a higher dividend in the future. We combine that with the willingness of a company to actually do a higher dividend or a special dividend, and that really takes a lot of qualitative work, and so really distinguishes us from some of those quant managers out there. We're doing both the quantitative and qualitative, and that willingness, identifying the willingness of a company, really requires you to talk to the boards, get an understanding of capital management, talking to the companies, how they're incentivized to give back to shareholders. A company like like Harvey Norman, we know that Jerry has got lots of franking credits on his balance sheet, but probably is not that willing to do a special dividend, or at least he hasn't shown that over the last 20 odd years, versus other companies who may be more capital management friendly to their investors. So our edge is identifying that, both the ability and, importantly, the willingness for a company to pay. And special dividends, since off-market buybacks were banned in October, or effectively banned in October 2022, have been the vehicle in which companies are giving back to shareholders. So getting set well before they're announced is the key, and we do that by identifying both the ability and willingness to pay a dividend.
I saw that in your slide deck. I'd never heard it phrased like that. I just think maybe people don't stop to think about it. You can have the balance sheet, you can have the cash flows, but then do you have the willingness? And like you said, there's no, like, as far as I'm aware, there's no quantitative screen that says, yes, they're willing, versus actually just speaking to them. So it's kind of like that falls out of the process just naturally because you're doing so many meetings and you're able to ask those questions, as well as look at like the REM reports and that sort of thing. You're able to actually just eyeball them and say, what's your philosophy of this? How are you thinking about that? That makes so much sense. I've only got a couple more questions here for you, Michael. And people, of course, I'll put links in the show notes to the Solaris website. There is a LIC as well, so a listed vehicle. There's the funds directly, which you can learn more about on the website, of course. A couple of the questions that I have for you, one that you emailed about yesterday, which is that you said people are asking you if the stock market's becoming more volatile, and if so, why? So what have you found?
Yeah, so the number one question that our clients are asking when we go into meetings is, why is there so much volatility in this market? So the overall market has been relatively stable. I think in the last financial year to date, it's probably up 2 to 3%.
Yeah, so it seems okay, right?
It seems okay and has been relatively stable. But sort of beneath all that, you see some pretty big moves in sectors. So you've had metals and mining up 50 to 60%, energy up 30 to 40. And at the other end, you've had healthcare stocks down 30 to 40, software companies down 50%. So massive dispersion, and a lot more than we would have seen 5 and 10 years ago. And people want to know why this is happening, and is it structural or is it cyclical? And it is a change in market that we're seeing. And what we've seen over the last few years is we've seen, particularly in super fund land, you've seen a lot of the super funds pull some money away from fundamental managers, and it's going into both passive and quant. And there's a number of reasons why that's happening. And one is they want to reduce their costs. There's various performance tests that they have to satisfy, and there's a lot of de-risking going on from the big super funds. So it's taken away from the dominance that the fundamental managers have out there. So the big household names. A good example is CSL. So CSL has been under a lot of pressure, and a lot of our investors are asking, why has it gone from 30 times to 11 times? And while they've had some downgrades, the D rate in terms of that PE is just enormous and way bigger than it would have been in the past. And in the past, you would have had fundamental investors stepping up before now, and you probably would have seen a PE of 15 or 16 times rather than the 11 times, which is a 45% discount to where the market's trading at. You would have seen it trading closer to that 15 times. So we've seen the rise of passive. So they don't determine the price, but quant are really pushing share prices around as well. And they're really focused on a number of factors, but including both the price momentum of a company and the earnings momentum. And so what you're seeing is, I guess we call it a valuation rubber band. You're seeing that rubber band stretched. And on one end, you've got CBA looking very, very expensive. On the other end, you've got CSL looking very, very cheap. Now, CSL, well, I'm not going to provide a forecast here. If those earnings stabilise, and you see some stabilisation there, you see people comfortable with management, it could be quite volatile the other way too. So It's a market where we're seeing more volatility within the sectors. Those companies that are having any sort of earnings upgrades, even small, are getting re-rated and bought aggressively. And then those companies that are disappointing are going the other way. But the great thing for fundamental managers is there's more price dislocations as a result. So it gives us opportunities, Owen, in the future, but you just have to, as a fundamental manager, adapt to the markets you're in. And our strong risk management focus really helps in that process.
Yeah, because you could insulate because you have the relative weightings to the index, but also the fundamental performance. The fundamental measures that you're tracking. I'm aware that this question is maybe like asking the barber if I need a haircut, which I don't because I do it myself these days. But does that make you more optimistic for active management going forward?
Well, that's a great question. So I'd like to think that we've seen the end of the super funds move into passive. I know quant is looking quite full. There's not a lot of capacity in quant, so that's good. And we are seeing a good interest in our business from people looking for core diversified strategies. I do believe the returns will start returning for active managers, and we've just probably seen that in the last few months. The active returns are getting better as people understand that the market we're in. So we are in this market with volatility. As people sort of get on top of the markets and how they've changed, I believe the fundamental managers will adapt to the market we're in, and you will see a stronger performance and likely outperformance in the future.
That's really interesting, really good to know. Now, I've only got one more question, which is the final one that I ask everyone on the show. It's probably the hardest one, right? So feel free to take your time and think about it. But the question is, if you could go back in time and tell your younger self, could be at any point in your life, one thing about finance, business, money, investing, what would it be?
Well, it would be read more about the experts out there. And then listen more to the people you work with. Because you don't want to clone someone out there in the investment industry, but you want to take bits and pieces of all the experts out there and then develop your way of investing. So that's the most powerful thing for me, is just taking little bits and pieces from all the other investors out there, whether you read more, whether you listen more to your colleagues out there, and take away that good stuff about investing that they do and develop your own way of investing. And that can be very powerful.
Oh, well, I really like that, Michael. That's a really good answer. So thanks for taking time out to join me here in Melbourne today. I hope you enjoy the city, but and all the best with Solaris. You've got the runs on the board, you've got a great team that's stuck around for a long period of time. So it's great work you're doing. And once again, thank you.
Thanks, Owen. It's been a pleasure.
I regret to inform you that chances are a lot of you will need financial advice. Since we started the Rask Advice business, I've noticed quite a few trends, but one of them is the importance of having confidence in what you're actually saving towards or investing towards. A lot of people in the Rask community are very capable of managing their own money, but when it comes to critical points in their life, like retirement, selling a business, scaling a business, getting married, buying your first home, so on and so forth, getting expert advice will actually save you from a bunch of mistakes and give you the confidence to know what it is you're doing and why you're doing it. If you want to get matched with one of the trusted financial partners that we have, you can just head to rask.au/financial planning, or you can get in contact with us on any of the Rask websites. Not only does Rask itself provide financial advice, but we also have trusted partners if we're not the right fit for you. So we can help guide you in the right direction. And that in turn supports us to create more free financial education content like podcasts, courses, and so much more. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.